Good afternoon, boys and girls. It's the weekly wrap-up for February 4th, 2022. It's a Friday. Hope everyone had a terrific week out there in the interwebs. I'm Raymond Dahlman, your humble host here at the Liberty Call podcast. And if it's your first time watching, be sure to subscribe and select notifications so you can be on time every day. I usually try to do this about 20 minutes after the hour. So if you're on the East Coast, that would be 4:20. If it's, Central Time, 3:20, and here in the Mountain Time, it's 2:20. So figure 20 minutes after the hour is always, or after the market closes, is a good time. I'm a little late today. I was working out and had to finish and cool off before I got online and started talking to you wonderful folks. So, all righty. Well, let's see here. Let's go ahead and jump in to see how the major indexes did today. Kind of a volatile day in the markets. The Dow Jones was down 0.06, closed at 35,089. S&P 500 was up 0.52%, closed at 4,500.54. NASDAQ was probably the biggest winner here in the U.S., up 1.58%, closed at 14,098. Small caps are up 0.71. The VIX was down 4.64% today, closing at 2322. So that's good news as far as the volatility. It does appear to be waning a little bit here at the end of the week. Excuse me. As far as across Europe, lots of red. The only green I see are the Bovespa and the S&P BMB IPC. So across Eastern Europe into Asia, the only greens I see are the Nikkei 225 up 0.73 and the S&P ASX 200 up 0.6. New Zealand was down. Shanghai was down. The SE component was down. The China A50 was down. The DJ Shanghai was flat, and the Hang Seng was up 3.24. So kind of a mixed day across the globe. We had, kind of a mixed overnight, and here locally or domestically in the U.S., things appear to be a little bit better. We'll see how things, when the market opens on Monday, how that turns out. All right. Well, let me drag over my chart so we can take a look at the week in the Dow. Let's see how we did here. All right. The Dow was up about 1.14%. The S&P 500 looks like it was up 1.43% for the week. The the NASDAQ appears to have been up about 1.28%. And the Dow Utilities, let's see how they did. It's up about 0.5%, and the Dow Transports appear to have been up about 1.19%. So all in all, not a terrible week in the markets. So let me take a look and see how looking at the Dow Jones from a volatility perspective, we can see that the ups and downs appear to be within these channels. So looked like a few days ago, a week ago, we were going to break through and plunge through this downward resistance line, but we haven't at this point. So, let me see if I can drag that out. So again, you can see how it kind of bounces up. It gets to a point of resistance and then trends back down. So we've been doing this really since the fall. Let me drag this out. When we broke this longer trend line that we had been in since things recovered almost 2 years ago, you can see clearly that it was bouncing off this line of resistance and then finally broke that line of resistance in late summer, early fall last year, and has really kind of just been in this sideways movement for the last, 5-6 months. So, if we were to break out above, that would be a clear sign that, we're headed for, better times, I guess, from a dollar perspective. But, I would more anticipate that we'll break through this bottom line of resistance at some point, which will, lead to whether or not it's a correction, recession, whatever it's going to be. I don't claim to have that sort of insight. So, All righty. Well, let's go ahead and take a look at the job numbers for the week. Jobless claims or initial jobless claims came in at 238,000. Forecast was 245. Last week's numbers were revised up from 260 to 261. So again, still right on forecast for that last week. This continuing jobless claims came in at 1,628,000 against a forecast of 1,620,000. So 8,000 over forecast. Still not too bad. Last week's numbers were revised down from 1.675 to 1.672. Last week was, even the revision still keeps it above what the initial forecast was. All right. U.S. ISM Manufacturing New Orders Index came in at 57.9. Last month's number was 61. So there's a little bit of a retraction in the, what is the ISM? It's a report on a business is based on data compiled for monthly replies to questions asked of purchasing and supply executives of over 400 companies. For each of these indicators measured, new orders, backlog orders, new export orders, and import. There's a lot there. This report shows the percentage reporting each response and the net difference between the number of responses in the positive economic direction and the negative. So it's basically just a survey. So all right. The job openings and labor turnover survey came in at 10,925,000. Forecast was 10.3 million. So a bit above the forecast by about 600,000 folks. So, again, there's a lot of jobs out there open, whether or not you're qualified for it or you're whether or not it fits into your, what you think that time is worth, that's a different story. All right. U.S. factory orders month over month, there was a 0.4% drop. The forecast was 0.2. So just slightly above, slightly worse than what we were expecting. As you can see, the last few months, we had positive numbers. This is the first one where it's gone into the red since, what was that, June 4th of last year. All right. Nonfarm payrolls added 467,000 versus a forecast of 150,000. So that seems like a positive bit of information. Unfortunately, the unemployment rate ticked up 0.1% to 4% for this month. Forecast was originally to stay at 3.9%. All right. The U.S. or the rig count, we're at 497. Last week, we were at 495. We've kind of been in that high 400s for going well over a month now. So like to see this get up to, at a minimum, probably close to 600. So we're about 100 rigs away from that. I'm not in the oil business, so I couldn't really tell you whether or not it's a regulation problem or just a getting rigs set up and back online. I couldn't really answer that question, but it has slowed down a little bit. Again, it could be just seasonally. I couldn't really say. All right. So I got a couple three articles here for you for your pleasure. Oil blows past $90, rising for the seventh straight week as Texas freeze grips the U.S. So this is written by Bharani Krishnan from investing.com. The unhinged oil rally had everything going for it, from geopolitics to supply politics. The only thing missing was a real weather crisis, made up this week by the Texas freeze that tipped the market firmly above 90 degrees on fears that the Permian Shale Basin could get frozen again like last year. U.S. crude and its UK peer Brent rallied for the seventh straight week, racing toward Wall Street banks' call for $100 a barrel oil. To be sure, the target was made well before the Russian-Ukraine crisis, half-hearted production hikes by OPEC Plus, and now the Arctic blast gripping much of America, including Texas, the fourth hottest U.S. state outside of winter. Crude prices seem to have a one-way ticket to $100 oil. Ed Moya, analyst at online trading platform Owanda, wrote in his weekly commentary, this week's rally in crude oil was supported by OPEC Plus's decision to stick to their gradual increase strategy. And as U.S. production fell again, the Arctic blast is also disrupting some production in Texas, and that is driving the latest price surge. Everything seems to be turning very bullish for WTI crude, and the bullish momentum might not see much resistance until the $95 level. New York-based WTI, or West Texas Intermediate, settled up $2.04 or 2.3% at $92.31 per barrel after a session high of $93.17. Week to date, the U.S. crude benchmark was up nearly 7%, while the cumulative gain for the 7 weeks running was 30%. So oil's up 30% in just under 2 months. Not a good thing. London traded Brent, the global benchmark for oil, settled up $2.16 or 2.4% at 93.27 after a new 8-year peak at 93.69 intraday. Week to date, Brent was up about 4%, while its cumulative advance over the 7 weeks was 27%. Year to date, Brent has gained 20%. The rally in oil gained new impetus as the focus fell on this week on Texas, where temperatures were forecasted to dip below 20 degrees in many parts in the coming days. So that's about it there. So it doesn't appear great from a energy perspective, whether or not it's putting gas in your car or heating your home. Things are getting a little more expensive, and I don't see this receding at the moment. Although I do find it funny that temperatures in the 20s are, all my friends back in Texas, and I still follow a lot of news sites and things back in the Houston area, and the panic and, oh my God, it's gonna freeze. It's like, dude, I cleared my driveway yesterday morning. It was 5 degrees in the sun. 5 degrees outside. I mean, it's the weirdest thing. I mean, I'm wrapped up like Randy from A Christmas Story, and I'm out there with my snowblower. And after a few trips up and down the driveway, I'm usually sweating pretty good, except my hands are frozen solid. It feels like it's like my hands are numb, and I'm sweating everywhere else. So it's a fun experience. So today, what's the temperature? 36. It's balmy outside. It's above freezing. You can almost drink water. It's so warm. So anyways, all right. Next article here. The U.S. 30-year real yield turns positive as Fed hike bets increase. And this comes from Bloomberg. The inflation-adjusted yield on treasuries maturing in 3 decades time climbed above zero for the first time since June after stronger than anticipated U.S. jobs data added fuel to the argument for faster tightening of their Federal Reserve policy. The so-called 30-year real yield is measured by Treasury inflation-protected securities, jumped more than 4 basis points to 0.024%, an unseen level since May. The last time the benchmark was above zero was in June. Nominal treasuries slid to their lowest of the days following the employment data, with the front end and belly of the curve leading declines. Swap markets showed around 32 basis points of tightening priced in for the Fed's March meeting, slightly more than before, suggesting the market sees at least a quarter point of tightening as a done deal, and around a 1 in 4 chance of a supersized half point rate increase. Around 130 basis points of increases are priced for the whole of 2022. Non-farm, now we already covered the payroll stuff. So Jerome Powell signaled last month that the central bank is likely to begin a cycle of interest rate hikes in March and open the door for more frequent and potentially larger hikes than anticipated. The jump is already unsettled risk assets, which are grappling with the end of accommodative monetary policy after rallying over the pandemic. So, not a good idea. It's not real good when your 30-year bond is, has a negative yield based on the tips. So, we're in a world of, things are a mess right now financially as far as the way this country's going. So don't be surprised if there's some, bumps in the road. I try to be as upfront and, no BS as possible. So I don't have a good feeling about this. All right. This article comes from Yahoo Finance. Last one here is how to avoid capital gains tax on real estate. I figured this is some good information for those who are out there looking at possibly buying or selling a new property. It's something that my wife and I have been looking at, just kind of browsing around. We're looking for some acreage. We live on an acre here out in the middle of nowhere, but it would be nice to have 100, 200 acres, something with a stable and maybe some land to have some cattle on. Just simply diversify. You never know when the world's going to come to an end, and or at least the world as we know it, and you have to got to eat. All right, home prices have nearly doubled in the last 10 years, and that could mean you owe some serious taxes if you're selling your home. After bottoming out around $259,000 in 2011, the average sale price of a house has marched steadily upward upward to more than $453,000 at the time of writing. Like many trends, the pandemic may have accelerated this, but housing prices had already been rising for years. This has come as great news for homeowners looking to sell. They stand to make some real money. Unfortunately, with real money comes real taxes. If you sell real estate for a profit, you will owe capital gains taxes on the money. Unfortunately, unlike the taxes held from wages, the IRS doesn't take that money up front. You have to calculate it and cut a check. There are ways to make that hurt less, though. If you want to minimize your tax bill from a home sale, consider working with a financial advisor. Hey, I know somebody. I know a few, actually. What are your capital gains taxes on real estate? Capital gains tax is levied on any profit you make from selling of an investment. This applies to most money that you make through the buying and selling process, such as stocks, bonds, and even real estate, such as your house. In the case of real estate, you would calculate your taxable profits as the price you sold the property for minus the price you paid to buy the property equal taxable profits. So, for example, say you bought your home for $260,000 10 years ago. You sell it today for $450,000. You would owe capital gains taxes on $190,000, the difference between the buy and the sell. Long-term capital gains, that is, gains that are held for at least a year, are generally taxed at a much lower rate than earned income, money that you get from working. In 2021, for single married filers, the capital gains rates have been set at, and it shows here, 0% if you make less than $40,000 or $80,000 married, 15% from $40,000 to $445,000 single, or $80,000 to $501,000 married, and 20% if you're single and it's over $445,000, and $501,000 if you're married. And it looks like the rates slightly go up for 2022. And here it has an example. So from our example above, so say you sold your house and make $190,000 in profit in 2021, assuming you're single, and you would calculate your capital gains rate on the sale as follows. If it 40,400 times 0%, 190,000 minus 40,000 equals 149,599. 149,599 times 15% equals 22,439, and that would be your tax burden that's owed on the property. So pretty simple. I mean, it's just some basic math. And that's basically it. There's not a whole lot of other. I mean, you can also deduct, costs for home improvements and things like that. So, and also brokerage fees and the costs of selling the house would also come out of that cost for you too. So, all right. Well, that's everything that I had for this week. Hope everyone has some fun plans for the weekend, and I'll be back on Monday with the weekly economic update with what's the upcoming data or information for next week. And like I said, if anyone needs anything from me, don't hesitate to shoot me an email or drop me a phone call. If there's a topic you'd like me to do some research on or expand on, I'd be happy to do that. So hope everyone has a great weekend, and I'll be back Monday. Bye-bye.